We had the opportunity to sit down with James Romero. He's a reverse mortgage specialist with Shore Capital Corporation out of Ventura, California. Hopefully, you learn a lot about reverse mortgages and what they're all about. There was a lot I didn't know, and I found it quite interesting. From all of us at Care for Seniors, thank you for watching, and thank you again to James Romero.
James Romero, Shore Capital Corporation, mortgage lender, and I am a reverse mortgage specialist.
All right, reverse mortgage specialist.
Been in the industry 25 years. I've been specializing in reverse mortgages only for the past 11.
Okay, so what exactly is a reverse mortgage?
In a nutshell, it's basically a deferred payment program. It's a mortgage like any other mortgage. Primary difference is, unlike your current 30-year fix, which you have to make that payment on the first of the month every month till it's paid off, you refinance or sell the property. Reverse mortgages allow you to defer that payment to a later time. Those times being either you move out, you sell the property, or the borrower passes away. All those payments get paid at once. Deferred payment program is basically what it is.
Okay, so who qualifies for a reverse mortgage, or how does the qualification process work?
Qualification isn't as easy as they make it sound on the commercial. It is a much easier process than qualifying for a traditional mortgage. And the reason for that is you're still qualifying in every other way except for the actual payment. You don't have to show the income to make the payment because making the payment is optional. However, you still have to show income to make sure you can pay your property taxes, your homeowner insurance, the other items that show up on your credit report, autos, credit cards, revolving debts, etc. So that's the basic qualifications in a nutshell.
So you go through the same essential process as a traditional home loan mortgage.
Same process, same underwrite.
You pull their credit score,
Absolutely.
you do proof of income,
Correct.
all that.
All
And
that.
you look at their bank statements,
Their
everything.
security, pensions, if they're currently working, all of that stuff. Yes.
Everything.
Yep.
But the ratios will be different.
Correct. Different in that, so they're not hitting you with the debt of a mortgage because, like I said, making that payment is optional.
Yeah.
So the underwriter doesn't hit you with that debt. And on a
That
traditional
debt to income ratio, right?
So everyone has a debt to income ratio.
Okay.
This is your income, this is your debt.
Yeah.
So they take off the mortgage. So automatically, most people qualify right there. Plus, on a traditional, conventional 30-year fixed, they like to see a debt to income ratio below 50%, right?
Okay.
The reverse mortgage will allow that debt to income ratio to go all the way up to actually 100%. You just have to make $1 more than your monthly debt.
So is a reverse mortgage only available for certain types of homes or locations or types of properties?
Not anymore. I'd say 10, 15 years ago, condos were very restricted. They had to be FHA approved. A lot of complexes just don't keep up with that and go through the process. So what happened in turn was a lot of new programs came out to compensate for that. And what you're seeing out there are what we call non-warrantable condos. You can loan on those multiple units.
So they don't have to be FHA or VA.
Don't have to be FHA approved anymore.
Okay.
2 to 4 units, 2 units, 2 manufacturers on one lot. And also, you're seeing jumbo products and other proprietary products where they don't fit in the traditional FHA box.
Got it. And then single family homes. So a traditional house that is kind of automatically qualifies, right?
Yes. Unless you're basically in like a $3 million property and you need to borrow $1 million, now you're in a jumbo category.
Okay. Regarding the condition of the property, does an appraiser come out and give a value to the property? Are there certain conditions of the property that have to be met in order to qualify?
I actually love that question because I go over this in detail every time I meet a new client. So what the appraiser is actually doing is they're doing 2 things. They're putting a value on the property using comparables, recent sales in the neighborhoods, but that appraisal also doubles as an inspection. Now, what they're really looking for is the property has to be up to a minimum living standards, meaning your carpet can be 20 years old and pet stained, but it has to be covering the floor. Appliances have to be functioning. Water heater double strapped and braced for California earthquake safety. Stuff like that.
Almost like a VA appraiser.
It's almost exactly like a VA appraisal.
So yeah, the VA has certain guidelines and orders.
Your roof could have a lot of years on it and be looking pretty shabby, but if there's no missing tiles and there's no signs of leaks, it's okay. If it's leaking, that's a problem.
Okay, so how is a reverse mortgage different from a traditional mortgage or a home equity loan?
First difference is a home equity line of credit is usually a second lien, second mortgage on top of your first lien, smaller, and it's a line of credit. A reverse mortgage is a first loan. It is in first lien position. So just like if you were going to go out and get a conventional 30-year fixed, they're going to pay off all your other loans. Your current 30-year fixed, you're going to pay off your current HELOC and put a new loan in first lien position. That's what a reverse mortgage does. It's a first position loan.
What if the home already has a HELOC? Does that have to be closed?
It would have to be closed, yes. It would have to be closed.
Okay, and then once that reverse mortgage is in place, you're essentially not eligible to do a home equity line of credit at a later date?
Technically, you are. So FHA won't inhibit that from happening. However, most lenders won't lend behind it after that point. They're not going to want to loan. They're not going to want to loan behind a loan that's showing a negative amortization. Plus, we can get into more detail later. Most of my clients aren't qualifying for a HELOC on top of having already borrowed money. One of the reasons they're looking into a reverse mortgage in the first place is to cut expenses. So I like HELOCs up to a certain point if you keep them small and can have the ability to repay them. However, anytime in my history that I've seen a HELOC that goes more than $50,000, $100,000, $150,000 HELOC, I've never once seen those loans get paid off. They always get refinanced back into a first mortgage, back into the property, and now they're paying interest on the interest that they paid. Yeah.
Is there a minimum age that a person must be in order to qualify, or is there an amount of time that they've needed to own the home in order to qualify?
No, you just need to have ownership interest. One day you can buy it today and apply tomorrow. Minimum age on the traditional FHA is 62. On those proprietary products we were talking about early, minimum age 55.
So 55 on private.
Yeah.
62 on an FHA.
Correct. Yeah.
And are you going to get more money versus FHA versus a private? Or is it just kind of based on this scenario?
It is scenario based. So 3 factors: the property value and the current amount that you owe, plus the borrower's age is a variable on what they call your principal limit, the amount you can borrow. So having a property that pays for $1 million, a borrower that's 62 years old versus a borrower that's 76 years old, the borrower that's 76 could probably borrow $100,000 to $125,000 more on the same appraised value. So the older you are, the more you can borrow. The younger you are, the less you can borrow. Say you're 70 years old, you come to me, you're thinking about a reverse mortgage because you're now widowed and this $3,000 a month house payment is just killing you. Your property appraises for exactly $1 million. You owe $300,000. You qualify for, say, $450,000. So just like any other loan, first thing that gets paid out of that $450,000 is your current mortgage. The rest of it, the $150,000 that's left after paying off that $300,000, will be set up on a line of credit available to you to use as you please.
Oh, so it's almost kind of like a HELOC. A little bit.
That line of credit, the available that's left, works similar to a HELOC in its draw period, because that line of credit is available to you for the rest of your life as long as you're living in the property. It doesn't turn at any point or get called or have to be repaid back in a certain period of time.
So it's almost like sitting in the bank account, which is essentially your house.
Mm-hmm.
Okay. In order to access that, do you have like a credit card, or is it like, how does that work?
No, customer service number, whoever's servicing the loan at the time. The first time you draw from it, will be a little clunky and take a few business days.
Yeah.
And you'll give them a routing number, your bank account information, and then basically wire funds. 2,000, 5,000, 10,000, whatever.
So if I needed to buy a car for like 10,000, and I just wanted to pay it outright, I wanted to draw from that, I would call the customer service and then they would wire money.
Wire directly into your bank account.
Oh, so there's more benefits of just a deferred payment or deferred, you actually have the opportunity to get cash in hand.
Absolutely, yeah.
The individual homeowner has a mortgage, let's say with Wells Fargo. Can they pick up the phone, call Wells Fargo, and do a reverse mortgage through that specific company? Or are there just certain companies that do reverse mortgages?
There are only a handful. So Wells Fargo and B of A got out of the reverse mortgage industry about 15 years ago. So 15 years ago, mortgages just weren't as regulated as they are today, right? And that includes reverse mortgages. So it was the Wild West out there as far as loaning money. And it got messy. There was a lot of corruption. There was a lot of misunderstanding. And B of A and Wells Fargo were both right in the middle of all that, including their reverse mortgages. So when the whole thing melted down, they got out. So what you're seeing out there, there's about 5 or 6 primary large reverse mortgage lenders that everyone either brokers out to or mortgage banks to, or small mortgage banking companies like we are here, fund and sell the loan to these. But there's only a handful, and that is all they do. And I'll tell you this, as far as the reverse mortgage industry goes, only the lenders who specify in reverse mortgages are successful. I've seen in the past 10 years, I've seen Remen and these other lenders you're familiar with come in, last about a year, it all falls apart. It's different. It's different. So it's not that big. I think the entire industry, so I've been 11 years now, and I'd say across the country, from the loan originators to the account executives and everyone that works on the inside, not much bigger than a large high school. It's not a big industry. They're pretty small, which I like. Because again, going back to you can't burn bridges.
You have to do good business to stay in business.
Yeah, you do. Yeah, they all know each other. So what I do is I've created my own little processing system. And I go through steps. Step 1, what I do is I let the potential client get to know me. So I'm not some mortgage guy over the phone, just within 30 seconds, asking them for a lot of personal information. I let them get to know me. I let them know I'm here, no pressure. This loan is not for everyone. And if it doesn't work for you, or I see another viable option for you, I can and will advise you right out of a reverse mortgage if that's what's best for you. It's not for everyone. Step 2, I check eligibility, your age, the property value, the type of property, all those variables that are going to come into play on that appraisal we were talking about earlier in the underwriting process. I make sure the eligibility is there before I put anyone through the process. If the eligibility is there, then I go ahead and start collecting information and what we call pre-qualify you. Looking at credit, income, assets, reserves, etc.
Do you have to look at the individual's medical history at all, or nothing like that?
No, not.
Okay. So if there's a husband and wife living in a home, the wife gets dementia or whatnot, the husband can't afford to put that individual into an assisted living, so they choose to do a reverse mortgage, pull money out, because there's that opportunity for that money that's there
That comes up.
and then they can that individual can place that loved one into an assisted care, and that's
Yes, it's not as simple as it sounds because the state of California Community Property State, they both have ownership interest in the property, no matter how title shows. So, and then you mentioned dementia. So hopefully this is where you cross your fingers and hope that there's a trust in place with a healthcare directive. And I spend a lot of time on the phone. It has nothing to do with my business, advising my clients and getting a trust. Everyone, please get a trust. It's in you and your family's best interest. inside that trust, the healthcare directive, 2 doctors' letters declaring that it's an ugly word, I know, but it says on the trust, incompetent. So if incompetency's there, she can't sign. She wouldn't have to be on the loan. He can take care of everything. And then at that point, he can do as he wishes to take care of her.
Stay at his house on the reverse mortgage.
Correct.
Take the funds that
Correct.
that are obtained
Yeah.
and pay for that assisted.
Yeah. If there's no trust, it's going to complicate things.
Got it.
It's going to complicate things.
If there's no healthcare directive, no anything like that.
Yes.
So that person living in the home, can that senior stay in the home until the day they die?
Absolutely. Yeah.
Okay.
Absolutely.
Deferred payment. And then once that person dies, what happens?
Basically, again, this is where you want to trust. The instructions of the trust will be followed. And that loan will get paid off just like any loan, any other loan. So say you were to inherit a property today from a family member, a parent, and there was a $400,000 conventional 30-year fixed on it, you'd have to pay off that loan. Whether you refinance it, keep the property, or you sell the property, gets paid off. No difference there.
Same thing on a reverse mortgage.
No difference. Your escrow officer will call the lender, get a demand for payoff, and that's what will get paid off.
Oh, interesting.
That's it. It could be.
It's almost
it
like a
could be-
regular mortgage.
It is.
I didn't
Just-
see. I was totally confused on what this was.
There's no difference there.
Okay.
VA, HELOCs, they all get paid off.
Yeah, I didn't see. I was totally confused. I thought the bank took over once that person dies, that whoever had held that reverse mortgage takes over.
Here's where that comes into play. So a reverse mortgage is the only loan in the country right now that does have non-recourse. Meaning, if you inherit a property today, you don't just inherit its value. You inherit all the good and all the bad.
Yeah.
The liens, the taxes, the insurance, any mechanics liens that show up, any problems with it, etc. So, and you got to take care of all that stuff. Or what a reverse mortgage allows for, this is what scares people, but it's actually disguised. It's a benefit in disguise is what it is. If you were to inherit a property and it has a reverse mortgage on it, your parent got it when they were young. They outlived the equity. It's got all kinds of issues and fix it. You do have the option and you can walk away, non-recourse.
So essentially, if they're upside down in the house,
They're upside down. It needs
a ton of work.
Needs a ton of work.
That heir can walk away.
Yeah, it's going to be more of a cost to you over the next year than it is a benefit. You can walk away non-recourse. On a traditional loan, can't do it. You're taking care of that property. You're getting it sold. But that same non-recourse clause is what scares a lot of people. The bank's going to steal my mom's house.
I've always thought, like everybody else, you get a reverse mortgage, that person dies, that house is gone.
No.
Okay.
So having been doing this 11 years, a few years ago, I've got to the point where some of my clients have now passed away. So I get calls from the adult children. What do we do? How do we do it? I call the trust attorney. I guide them through the process. There is a process. And basically that process in a nutshell is you want to notify the lender servicer as soon as possible. There are specific dates and timelines that come into play, and that timeline starts at the date of the death certificate. You have 90 days to notify the lender or servicer what your intent is as the heir. I'm going to keep the property, I'm going to sell it, I'm going to refinance it, live it myself, whatever your intent is. You have up to 180 days to execute your intent. You also have 2 90-day extensions as long as you're in the process of executing your intent to complete, which gives you an entire calendar year. But remember, those dates don't start when the family picks up the phone and calls, gets around to it. It starts at the date of the death certificate. So you have up to a year to decide what you're going to do and execute your intentions. At that point, this is where it can get really confusing. If you've done nothing for a full calendar year, then the bank will do what's called execute a trust deed, which is very similar to a foreclosure process. They'll sell that property, pay off their loan they're carrying, and then give the heirs any funds that are left.
So, how can a senior avoid from being scammed or taken advantage of during this process?
That's actually a pretty easy question to answer. Since, if anyone's familiar with the mortgage meltdown, 2008, the enactment of the Consumer Financial Protection Bureau and all these regulations to the point where we felt like we were overregulated in 2010 to 2012, you can't really get scammed. It's extremely difficult. It would literally take a conspiracy between the mortgage company, the loan officer, the escrow officer, the underwriter, would all have to be involved for a scam to take place these days. Too much regulations in place. Here's the biggest fault with the industry when it comes to reverse mortgage, and it's two parts. One is you call an ad on TV. You're going to get some young person in Texas or Connecticut who really doesn't know what they're doing, or maybe have your best interest in mind. They're trained to sell. You might end up with a reverse mortgage that you don't completely understand, or maybe even know if it's right for you or not. That could happen. Were they scammed? No, but they were sold on a product that may or may not been their best viable option. That happens.
So, with that said, are you personally able to do loans just here in California, here locally, nationwide?
Not nationwide.
How does that process work? Does the loan officer need to be local to the area or the state, or?
If you work for a large enough bank, you can be nationwide.
Okay.
However, keeping it small to medium size has its benefits, because when you work locally, you have that reputation. And my reputation is what I live off of. So most of my work is done in and around, I'd say, between Santa Barbara and San Fernando Valley. Knowing as many people as I do and having taken care of as many clients as I have, I recently got a referral just outside of Sacramento. It was referred to me. It was a warm handoff. It was a nice introduction. She immediately trusted me. So that goes well. So all of California, some neighboring states, including Texas, I can do them. But you have to realize my reputation doesn't follow me there. So hopefully there's a referral and a warm handoff, so it's not a sales call.
Let's say you get a call for somebody in Utah or whatnot, and you don't work in that area. Are you able to find a person just like you in that area?
I do that all the time.
Okay.
I do that all the time. I don't want to get too off topic because it'll be, I use account executives.
Okay.
You're familiar with
Yeah.
that. The general public is not. And they work nationwide.
Yeah.
They have nationwide accounts. So I'll usually get two names. I'll talk to them. I'll fill them out. And I'll also mandate that they keep me informed along the process. So I'm keeping one eye on it, even though it's not my transaction. I'm not getting paid on it. I can't get a referral. I don't want a referral, but I keep an eye on it for them. So if I refer it to them, I retain the option to keep one eye on the transaction, make sure it's going well and fair and in their best interest. Find me or find someone like me that knows everything there is to know about the program, the industry, and the people in it. And if it's not me, if you don't want to work with me, let me find you someone to work with that can answer all your questions. Put you in the right hands before you make a decision. That's all.